again, everyone. This is Gene Ahrensberg coming to you from Southeast Texas on Sunday, February 17th, 2013. We're not very far from a favorite lake of ours where the fishing is fantastic and the weather's just fine. This is a special Video Got Gold report. I want to talk about just one topic in this update: what to look for in a bottom of the indexes that track the smaller, less liquid, and more speculative junior miners and explorers. My good friend Eric Coffin of Hard Rock Advisors fame recently called attention to the charts in a way that I've done myself in the past, and Eric's comments are the motivation for this brief look at the TSX Venture Exchange Index, or the CDNX. In his most recent journal, Eric said, and I quote, "In our little corner of the market, gloom predominates. I've noted in print and in a couple of recent investor presentations that the current conditions remind me in some ways of 2009. I'm not expecting a gain for the year in 2013 that the venture delivered in 2009. That would be nice, but it's very unlikely," unquote. This is a chart that Eric included in that report, and he goes on to describe the CDNX in 2009 at the bottom of the previous bear market, noting that it didn't just launch like a rocket at first, but instead it more or less moved sideways for the first quarter of 2009. Immediately following the terribly brutal panic plunge bear market of 2008, there was a reversal signal, which I'll show in a moment. Once the CDNX did mark a new higher high and low, however, as Eric said, quote, "In 2009 the market turned up in mid-March and, with the exception of 2 or 3 small pullbacks, never really looked back until 2010, unquote. Essentially, the charts I'm about to review tell a story of what to expect if 2013 turns out to be an echo of 2009. We all know the old quote commonly misattributed to Mark Twain: "History doesn't repeat itself exactly, but it does rhyme." If 2013 ends up rhyming with 2009, and both Eric and I believe there is an excellent chance of that, then the charts we are about to review give us a clue as to what that rhyme might look like. There are important differences between the 2008-2009 worst junior bear market from hell and this current ongoing second worst junior bear market from hell. For example, in the 2008-2009 bear from hell, it was shorter in duration and steeper, a true panic rush to liquidity and crash. This current bear has been a long, slow, painful grind of a bear, as the charts clearly show. The relentless, ugly, confidence-destroying bear from hell, too, is quickly approaching 2 full years in duration. Recall from the subscriber chart of the CDNX that the current level suggests the CDNX is discounting roughly $300 gold because it is currently trading at levels first reached in 2002 when gold was just beginning its bull move. I know it sounds ridiculous, but when the CDNX first tested the 1200 level, that's when you could buy all the gold you wanted then for $300 an ounce. Not $500, not $750, not $1,000 or $1,250 or $1,500. $300. The little guys are trading right now where they did when the great gold bull was getting started. Yes, it's pretty ridiculous, but it is what it is. So far, since last summer, the CDNX has not made a new low, but it also hasn't printed a new higher turning high and low. Indeed, as of now, in mid-February, it's closer to making a new low than the opposite. The CDNX has crossed above the dashed 2-year downtrend line shown, but in a tentative, unconvincing fashion thus far. If this does turn out to be the bottom for the CDNX, then we would characterize it as a wide grinding support base forming now. Compare this current chart to the 2009 reversal and what the CDNX did then. First of all, once the massive tax loss selling ended in 2008. Note the relief rally of about 35% the last week of 2008 and the first week of 2009. That's the kind of tell I'm hoping to see just ahead. More about that in just a moment. Now, notice in the current CDNX chart a miniature version of a relief rally. Instead of 35%, the end of 2012 tax loss selling only allowed a 7% recovery bounce. At the end of the first bear market from hell, after the end of tax loss selling and the relief rally, the trading drifted sideways to lower for roughly 2 months, setting up the first higher turning low in a year in March. Recall that the big markets, the S&P and the Dow, actually bottomed then on March 9th, along with the announcement by the Fed of QE1. We're on QE4 now, with the Fed printing $85 billion per month, or about $4 billion per day, every business day, levitating the big markets as only the Fed can do. But that's not our topic today. Just remember that in that January to March period, the world was still in first stage panic, with very real worries that the global financial system was about to implode. Volatility on the Dow was just wild both ways then. And I think that period destroyed confidence so bad and sapped up so much strength out of the junior market that it still affects gamer psychology today, more than 4 years later. Even so, from late December to March, the little guys had bled out as much as they were going to. We call that overwhelming support, or OS, on the charts. When stocks get so cheap, they have trouble going any lower. By June of 2009, the CDNX was exhibiting a rally of some importance, marking a second higher turning high at 1154, about 476 points, or 70% above the panic lows in December. That set up the second higher turning low in July, which was quite a bit higher than the first higher turning low. I would argue that by this time, about 7 months after the CDNX showed signs of bottoming, the junior market was generally seen as improving and sentiment was still very poor but definitely on the mend. It took about 7 months from when the CDNX showed signs of overwhelming support before there was clear evidence of a good recovery, in other words. I'd also have to argue that the post-tax loss selling relief rally this time is not consistent with an end to the bear market. At least it is not equivalent to the large percentage pop that we witnessed in 2009. So, while we don't really know how the eventual reversal and recovery will unfold, I am personally on the lookout for a significant initial rise for the CDNX as a signal that liquidity is moving back into the little guys. A recovery could occur without one, of course. But if we were to see that kind of bullish signal, it would be as encouraging as it would be welcome. Now, not all companies advanced at the same pace when the little guys finally caught a bid in 2009. Some hardly improved at all for the first 6 months. Others screamed higher, and that moved the averages higher. For example, here's a monthly chart of Timberline Resources for that period, showing an 800% jump in 8 months from its panic lows at 19 cents in March of 2009. Notice that Timberline collapsed in price along with the rest of the juniors, but on remarkably tiny volume. It was a terrific example of a low volume panic spike, or LVPS, on our charts. In 2008, Timberline plunged from the 240s to 19 cents in 8 terrifying months, mainly because there were fearful sellers selling into few or at times literally no buyers, a case of hyper-negative liquidity. And negative liquidity is just jargon for when there's an abundance of selling and much less buying, more money leaving a market than entering. As anyone can see, once the panic ceased, it really did not take all that much buying power to strongly improve the share price back up to the 40 to 50 cent range in 2 months, where it traded sideways until the smaller juniors cut that second higher turning low in July. That was when the buying really kicked in, driving Timberline back up to the 160s for that 800% recovery. As luck and Providence would have it, would you believe that we are once again gaming Timberline in this horrible bear market? And although it makes less sense for TLR to be where it is, we vultures are once again gaming the bid at the same price we did in 2008. We'll see that chart in just a moment if we have time. Looking again at the bear market from hell today, I suppose an argument could be made that the 17% jump higher from July to October could be the pop signal that we've been looking for. An argument could be made for that, but I don't really think so. Instead, I'm looking for a pop similar to the one that occurred in January 2009. Let's take a look at that. There it is again. And notice that in 2009, the pullback couldn't retrace more than half of the surge higher. That's the kind of pop that I'm looking for. And this is our subscriber chart for the CDNX. When everybody's in surrender mode and nobody wants a junior miner, it may sound like a lot to ask for at this particular time, but the signal that I would really like to see, and one that would send a bullish recovery signal that is unmistakable, would be a surge higher, more or less out of the blue, that takes out the October turning high near 1350. Until the CDNX clears that hurdle and does so convincingly, it's going to be hard to call the chart a recovery. As of the close on Valentine's Day 2013, when we did some figures, that meant a jump in the CDNX of about 155 points, or roughly 13% from here. Now, with so much carnage in the juniors, it may not surprise you that we're hearing through the grapevine that there are several new vulture funds being formed right now to take advantage of the carnage in the junior market in Toronto, in Vancouver, and in California, if the rumors are true. And if it's true, and I'm inclined to believe it, then it's just a question of time before liquidity morphs back from hyper negative to positive again, especially once that new liquidity has an impact on the companies those new funds target. Now, we plan to have more about that in another report just ahead, but it doesn't take all that much liquidity to move the top, say, 10% of the juniors higher quickly. To summarize, what we've looked at is potentially a bottom consolidation forming in the CDNX now, recent weakness notwithstanding. We have compared the chart today with how the last major bear market from hell transitioned back to a bull market in 2009 as a model. We noted that the last bottom in transition occurred during what turned out to be a climax of fear back then, when the world was still racked with trepidation about the global financial system. Today, the CDNX is showing signs of a bottom and hinting that it has bled out about as much as it can, kind of like it did last time. And as we mentioned in a recent blog post, history has shown that all major bears in the past have morphed into major bull markets. Terrible, rotten sentiment and defeatist attitudes that dominate the junior scene today tell me we are getting very, very close to the exhaustion or capitulation phase, if it hasn't already occurred. That is why we vultures, we Got Gold Report subscribers and yours truly, are gaming the bid for a few juniors today to build meaningful, respectable positions in our favorite small junior miners and explorers. Like Timberline Resources, who, with their JV partner Montana State Gold Corp., who, by the way, is paying all the development expenses of their Butte Highlands project, should be mining high-grade gold from underground in Montana later this year, and it's trading at a ridiculous cheap 19 cents a share, less than a $15 million market cap. 19 cents a share, just like it was in the Great Bear of 2008. Or like Channel Resources, which has already proved up a 43-101 estimated 1 million ounce plus gold discovery in all categories, shallow gold in Burkina Faso, but it's been slapped down to what we call idiot cheap by panicky gamers. Just 5.5 cents a share. Channel has a market cap of less than 9 million. Someone can build a respectable stake in CHU for not all that much capital today. 100,000 shares is $5,500. You know, as we said in a recent piece on February the 10th, Sunday, look it up on the blog, bear markets are not very much fun to those who are holding shares they paid a lot more for, but it can be the best of times for those on the bargain hunt, like right now, in our opinion. Right now, gold has enormous purchasing power to buy mining companies, probably most it's had since the panic of 2008. The big miners, represented here by the XAU, and the little guys, have been driven into the ground by a wicked bear market again. The only question we will leave you with today is, will you be on board when the bear gives way to the almost certain bull market to follow, or will you wait until the bull has already made that signature pop higher to announce that the next recovery stampede is here? At Got Gold Report, we specialize in taking advantage of super negative liquidity on guru recommended juniors the market has mistreated. Then we provide deep discount liquidity when the scared, panicked, and kamikaze sellers come in too hot and try to sell too many shares too fast, hopefully giving us an ultra low entry. Then we hang on with both vulture talons until the ugly bear is killed, gutted, and skinned once again. Well, that's it for this special Got Gold report. Because of the nature of it, we plan to share it with the public soon after it's posted on the Got Gold Report subscriber welcome page, but only after an appropriate delay. Got Gold Report subscribers get it first. Thanks for watching. Bye for now.